How's it
Sean
going,
Q's.
everyone? Welcome back to the Predicting Alpha morning live stream. For those of you who are new to the stream, just a reminder, my name is Sean Ryan. I am the co-founder of Predicting Alpha. And for these Friday live streams, we're rolling into the weekend. We wanted to figure out a way to make these streams still high value, maybe have a little bit more fun with them. So for the Friday streams, I'm thinking I'll be joined by my business partner, Jordan, and we're just going to have, a discussion about the markets, right? Talk about trading, talk about winning, talk about betting, gambling, lots of different topics, risk taking, because I think it's a conversation that isn't had enough. You know what I mean, Jordan? Like when we talk about trading, everyone focuses on, look at that bounce. Wow, look at the market, or touching support, but there's not enough conversation about the theory or like the game. You know what I mean?
Yep.
So that's what we're really going to be focusing on for these Friday streams, right? The inner game of trading, but not the psychology, but like the real game of trading. So, if you guys have any questions along the way, just drop them in the chat. We want this to be a little bit more interactive than what some of the other ones have been. This isn't about me breaking down an idea. This is really about, talking about the tough questions about trading, right? What does it take to win? Why do most people lose? And just the reality of the game. Wow, Jekko, what's going on, man? That's a very modest hello. Usually it's a little more energy. Is everything okay, man?
Well, Q's are down, are about to go under 300 here. So
No, they're not.
yeah, so maybe Jack has long Q's somewhere in his book.
Oh man, he's still long Tesla. QQQ stock. Let's see. Oh man, it's down 1.15% today. You're kidding me. Crazy. So yeah, I guess maybe we can start with like a little commentary on that, Jordan. Like, how do you have your book structured right now? Do you have any long vol, any short delta? What's your book looking like?
Yeah, usually I like to have some relative value. Almost always. So, I'm long vol some places, short vol other places. I actually, a lot of the times I actually like these huge moves. So I'm hoping for a Nasdaq at 290.
I was gonna say Q's to 270.
Yeah, exactly. Two Qs to 270 would be very nice. But I do have, for example, short Tesla vol, which is in the elongated end of the curve, and that's not that's not performing as I would have liked it to.
Mm-hmm. But other areas of your book are sort of offsetting it.
Exactly.
So I guess a lot of people right now, like Jordan, I know you've been on a little bit of a social media hiatus recently, focusing on building the terminal and everything, but I'm sensing panic everywhere in the retail space. And when it comes to retail investing right now, everybody seems to think, it's either literally one of two things. Either when there's blood in the streets, you want to be buying, or, are we about to crash? And I feel like it's only one of these two things where someone's like, everything's cheap right now, or everything's about to go to zero. And, if you were in a spot where maybe you were leaning a lot along Delta right now, or you're sitting on a lot of cash looking to buy, what are some questions traders could ask themselves? Like what would be like the fundamental questions to ask yourself if you're in that spot?
Well, I think a lot of traders should, they shouldn't really be trading. They should be more investing. They should be in it for the long run. So these little these blips shouldn't really impact them too much. If you're trying to day trade these things, it's going to be really tough as a retail investor to do that. So if you have cash, I'd say you definitely want to get some exposure into the market. I know I was talking with my buddy the other day, and he was a little nervous to put in money in the market because it was at these highs. I was telling him like, hey man, you're not in this to day trade, right? Throw in some money, diversify your portfolio, and hopefully in the long run you're going to be able to get some reward there.
I get it. Like you remember we were looking at the 30-year chart for SPY, and you could barely see the dips. It's just a beautiful trend up and to the right.
Exactly right.
But then when you zoom in, it can look like chaos. Right. And it's like, what time frame are you trading on here? Are you trading the 1 minute time frame, the 1 hour time frame, or are you trading, the 10-year time frame?
Exactly.
Oh, that was really cheesy. I didn't like that. So then, yeah, man, I have my little lottery ticket on the Qs. It's doing pretty good right now. It's doing
Yeah, you
pretty
got a
good.
nice one, right? You're 308, 298.
298, 294, or
So if we can,
293.
so if we can just chop around here for a bit, that'd be a huge winner for you.
Yeah, exactly. Right. I just wish I, threw some more money on it. But then again, would I be saying that if Qs were sitting at 320 right now?
Exactly.
Right. Maybe not. Maybe not. And, maybe there's a way to incorporate that into this conversation. I think it was one of the best little intro bits for any trader out of that Augustin LeBron book, which is that you'll never be happy with your trade. There's always room for improvement, right? So you could have always bet more. You could have always bet less. You could have always held it that extra day or got out 10 minutes early. I think that's a part of why, with technicals can be so frustrating, because when you're looking at your entries and exits, it's all on you, right? It's always on you. It's like it's very subjective when you get in and out, and it always feels like you could have done something better, right? I could have entered better. I could have exited better. I could have seen this. I could have seen that. And I think it leads to this sort of, getting pretty pissed off with yourself.
Definitely.
Jekka's asking, why is there poker in the title? We're just going to talk about, we're talking about risk taking. We're going to talk about gambling a bit. We're going to talk about poker. That's it.
We also knew you were going to be in the chat, Jekka. We wanted to give you some pointers.
Yeah, we wanted to give you some pointers for the next time you get hammered in Atlantic City. Leave the bank card upstairs. that's the advice, Jekka. Mike is saying it's probably going to be some analogy about pot odds and expected value. It will be some of that, but it'll also be a little bit more. Maybe we can hop into that now, Jordan. Maybe talk a bit about like your experience with poker. Like, I'm not saying, I know you're not like a World Poker Tour WSOP champion, but
exactly. I got three bracelets under my belt. No. I never took it like to that level, but I always enjoyed playing, and I had like, I guess, a little bit of success. At least I could say I was a profitable poker player. But it did kind of like set my foundation for trading, which is just thinking in terms of positive expectancy bets, and understanding your opponents. It was a really good intro to into the stock market, and I would say it's definitely not as like there's not nearly as many combos in poker as there are in trading, but because it's like in poker you're sitting at a table, right? Where in trading there's so much more that's happening. So I think it's a really good introduction into actual trading.
Why do you think poker, like, would you say that poker and trading sort of rest on the same fundamental principles to be a profitable poker player and to be a profitable trader?
I'd say there's a lot of overlap for sure. Bankroll management, understanding your risks, betting with positive expectancy,
probabilities,
stats. I think there's a huge overlap there.
Yeah. I would say so too. Like, if you were to say like what the biggest one that like sort of got you thinking in that way, right? Not a lot of traders, maybe different at the higher levels, but think like that, right? Or can draw those similarities. Was there something that did it for you where you were like, wow, this is actually very similar? Was there a book you read? Was there a quote you heard, something like that?
Yeah, it was Bill Chen's book, The Mathematics of Poker. That really got me thinking. That one, and there was another book, I can't remember the name of it. Jekka, it was the one that I mentioned to you. If you want to just maybe put that down in the comments. There was just two books that I read that really just said that really made you understand what the game was actually like. That this game was actually a mathematical game, and it wasn't just look at your opponent, see if he's like rubbing his head the wrong way. Maybe that's tell that he's bluffing, right? That's how I initially came into poker. I was like looking at the tells. But once I realized that this is like the math in this game is extremely important, things start to change.
Got it. And I think that was there's something we can chat about. One of the similarities is bankroll management, right?
Mm-hmm.
And at PA, we sort of talk about it in terms of Kelly criterion as like a basic way to understand it, which is most traders will sit there and say, I only bet 2% of my account, or, the 2% rule, something like that. That's how they manage their bankroll. But when you start thinking about it in terms of your edge and your expected value, you don't necessarily want to do that, because what if you have an arbitrage? Well, you don't want to be betting 2% of your account on an arbitrage. That's actually bad trading, right? You should be betting everything. It's risk-free return. So I guess a fun question we could ask, right? Have you ever gone, which means there is a time to go all in, though, is really what I'm getting to. So Let me ask you, have you ever gone all in on a trade?
Yeah, I've gone all in on a few times on a couple trades. Sometimes I look back on it and I say, even though it was a profitable trade, I thought to myself, maybe it wasn't a real arbitrage. But there are definitely trades where I will put up almost all of my capital, and not because it's a pure arbitrage, but because the risk reward is so beneficial. Just the expectancy is so high, and I actually didn't mean beneficial. I meant extremely high. Both I call them quasi arbs, meaning that they're not pure arbs, but the risk is so small versus your return, and it's very unlikely that you do lose on the trade.
What sort of research does it take to be able to go all in on a trade?
I don't know if it's
or what sort of work goes in? Yeah. What sort of work goes in to be able to go all in on a trade?
Yeah, that's a tough one. You know what? I wouldn't say it's the work. I would say it's the opportunity. If the market's not giving you the opportunity, then you can't go all in, right? It wouldn't be in the sense of I worked extremely hard on this trade or on this research, and so I can go all in. It would be more of oh wow, look, this market is having a huge mispricing here, and so I can buy this and sell this, or maybe there's three legs you have to do here, but you can buy this, sell this, and do a straddle on that, and next thing you have pretty close to an arbitrage. And those that is just the opportunity the market will give you, but also the research that goes into find these trades, or the expertise that goes into find these trades are pretty high as well.
I got two questions that I want to ask you out of that. So number one is, I guess what I mean is, there's a big difference between throwing, if your account's $1,000 and throwing that on the line, and if you're managing money or something and throwing it on the line, right?
Mm-hmm.
So how do you build that trust in the trade, right? Like, how do you, think through all these outcomes? Like, that's what I mean by the work, right? Like, obviously the opportunity is there, but then it's like, okay, maybe I'm missing something here. You know what I mean? So how do you sort of tick off those boxes?
Yeah, you usually just, at least from my experience, is that right? So easy example. Okay, someone's coming in. Let's say it's a liquid stock, and someone's coming in and buying, let's say, the $50 strike, and they're buying it with huge size. Okay, maybe they know something. Maybe they're doing maybe that's inside information.
Yeah, they're getting bought out, something like that.
Yeah, and they're coming in and they're buying way above the average volume in these options here. And let's say it's a $50 strike. Well, you can come in, let's say they push it extremely far, right? And I've seen cases that this has happened where let's say you could sell that $50 strike and buy, let's say, the next month out $50 strike for, let's say, a zero cost calendar or a 5-cent calendar, right? So those trades, it's like that this is trading extremely, extremely cheap, and you're offsetting your risk by you're selling these expensive options, and then you're buying some options somewhere else to offset that risk, and you understand what's happening, and so you can get on huge size for those trades.
And then I guess the other side of it is, so something like that seems pretty like mechanical, right? That's just understanding market mechanics and being able to say this is screwed up.
Mhm.
But I think there's like this other side to trading, where once you sort of understand all these principles and stuff, which is more creative, right? Strategy development, things like this. And so how important do you think creativity is in trading, right? I feel like you have these two types of traders: the ones who say like they just, they'll have an idea and they'll go trade it,
Mhm.
or some people who are just like, sell vol,
Mhm.
buy equity, sell vol. That's it. But there's all sorts of fun, unique edges out there. And how important do you think the creativity is, and how can someone train their creativity? Right. I feel like creativity is something that can be developed. It's not like Picasso was just born Picasso. He became Picasso, right?
Mhm.
So how important do you think creativity is? How can a trader go about developing their creativity?
I think so you definitely need a good education. You need to be able to have the tools, right? If you're an electrician and you don't know anything about electricity or how current flows, you can't really get creative, right? If you don't have a drill, then you can't really, okay, yeah, sure, you can get creative, but it's probably not going to be efficient. And so I think the first thing we need to be creative is the tools and and the knowledge base, right? So,
Mm-hmm.
so for example, if you want to get creative, well, maybe you need to pull in data, and that means maybe you need some programming. If you want to get creative, well, you need to understand statistics so you can understand modeling, right? So you can try these new things. Um, so once we get those tool sets down and that education level down, and we understand how an option is priced, and we understand what's going on in the Black-Scholes model, and how maybe a dividend affects the Black-Scholes model, let's say. And once we understand this stuff, then we can go out and start getting creative, right? Like what we were just talking about with the dividends. Well, maybe there's an option out there that is not pricing in the dividend on one of these stocks. And so now you can, let's say buy the shares, short the calls, or create the synthetic in the options market, and you can extract out the dividend. So being creative, you need the education, and then you need to start reading and you start looking. But the education and the tool set is probably the most important.
What about the people you surround yourself with? How important do you think that is for creativity and good trading?
I think that's crucial. I was just listening to a podcast the other day on Alpha Exchange, where the guy on the podcast, Mark Friedman, was saying, something that's so important to him, or was so important to him when he was working as pre the financial crisis at one of the big banks. One of the things that was so important to him was being able to find someone who could give him ideas, who could at least get him thinking, right? Thinking about something he wouldn't have thought to look at. And so I think surrounding yourself with people who are looking at the markets and who are trying to find unique opportunities, and even if they can't give you an exact trade idea, they can maybe give you something that gets you thinking. So I think it's huge. It's really important.
So, the challenge with that though is who do you surround yourself with, and how can you evaluate someone to have in your circle, right? It's like that saying, you're the accumulation of or the average of the five people you surround yourself with, right?
Mm-hmm.
Um, but in trading, it's sort of tough to know who's making money, or who should you be listening to. So if you're trying to pick five people to surround yourself with as a trader, what criteria should you use to evaluate it to set yourself up best for success?
Yeah.
I know it's a tricky question, sort of. It's
It's a
like,
good. It's a good. Yeah, I'm just thinking about maybe some people in my circle.
yeah.
Um, so there's actually a couple of people. I'd say there are some veteran traders that I learned so much from. Right. So those guys, they teach me a lot, and they give me trade ideas for sure. Like, or at least I'm able to ask them questions about things that I'm looking at. Um, then I have, let's say, people who are maybe more on my level that you know are also looking at trying to find inefficiencies, right? And they might throw an idea here or throw an idea there. Then I also have people who in my circle who ask me questions. And I think, trying to explain, learning something and then trying to explain it is, I think, super important in your growth. And it kind of also gets you thinking in terms of ideas. So that's what I would say. I'd say, having someone who you can learn from, who's and verified experience, right? Verified experience.
What do you mean by
And,
verified experience?
Worked at some large institutions.
Yeah, but like, an investment analyst at BMO.
Yeah.
Yeah.
Well, I
It's a
mean,
big institution. You know what I mean? I want to get to the meat of it here. Like,
yeah.
Is it one of the, we can't just say, it's not like when you're looking at the market, it's like when you know.
Yeah.
Because clearly we don't know when we think we know.
So I'd say it's learning, trying to train your brain to learn, to know. Okay, trying to train your brain to know what is actually like, what makes sense. So, for example, reading a lot of Aaron Brown papers and listening to his podcasts, right? Understanding how he talks, what he looks for, and then seeing who also reference Aaron Brown or who Aaron Brown references, who talks similar to Aaron Brown, and then you start to kind of like build this almost like a third eye to be able to see, who's really BS and who knows their stuff.
Cool. And you know what maybe might be worth discussing here? So I think there's this huge sort of war between retail and institutional, right? It's always been like they butt heads, but I think what can maybe make it easier to learn from some of these people is to realize, there are some similarities between, a retail investor and an institutional investor.
Mm-hmm.
So, Jordan, what would you say are some of the key similarities between, let's say a PM, managing $1 billion and someone managing a $20,000 account? And then we'll go into some of the key differences as well after.
Yeah, well, they're really just the same person, and then they're trying to have the same goal, right? Like I'd say there's two types of institutional investors. There's like the person, and we're probably not going to talk much about this person, but like the person who is there trying to raise as much capital as possible, even though like well knowingly that they will not be able to outperform the market. Which that's a huge industry there.
Yeah, these are the out of the money put guys, the buy and hold S&P replicated things type guys.
Yeah, and like also exactly right, and also there are people who serve a purpose as well. So for example, I might create a hedge fund that serves the purpose of being able to hedge your portfolio if there's a market crash, right? And that serves a purpose, and that's I think we do need that in the market.
Yeah, they capture a certain type of risk premium or target a specific type of thing, like a deep value fund.
Right, but then let's say there are these other guys who are trying to actually generate alpha. Right, they're trying to do many different techniques, many different strategies in order to generate the highest possible return. And I'm trying to figure out where we were going with this now. Why? Oh, the difference between the two.
Well, the similarities, right? So like a key similarity between a retail trader and an institutional trader who actually cares about generating alpha is that they actually both share the goal of trying to beat the market. Right. So I think that's number one. And I think that's like something that really gets forgotten, right? Not every institutional investor is boring, sitting there doing their DCFs and they're not totally foreign to you. And once you realize that, you go, I think we can start asking questions like, okay, well, what are these guys doing to win? Because something that you learn over time is the big guys are the ones who won. Right? You can always tell if someone's a good trader because they should have more money at the end of the year, right? At the end of 5 years, they should have more money. And if they don't, well, then you can start to say, well, why are they not making money?
Mm-hmm.
You know what I mean? And if you do that long enough, you can get really big, right? Ken Griffin starting Citadel with 50 grand in his dorm room. Now he's the biggest market maker in the world. Right. And once you realize that he actually started that maybe in a spot similar to people on this live, it's like, well, what did this guy do? What does he do? Because clearly we're playing the same game.
Well, you try to find inefficiencies, right? And I think maybe that's a big difference between, let's say, a prop guy or someone, not managing too much money, right? Because once you start managing a lot of money, you start to move into just
the game changes.
Yeah, but let's say the prop guy managing, let's say, less than $10 million, $25 million. They're trying to find inefficiencies, right? They're trying to say, okay, well, where's this? Like, why is this priced like this when this is priced like that over here? And they're trying to, I think Ken Griffin was doing a convertible arbitrage, right? At the end of the day, there's so many markets are not perfectly efficient. They're very efficient, and there's friction in the market, right? There's transaction costs. There's regulatory issues, and for that reason, you can find these mispricings that are actually there, and that you can actually generate some alpha and grow an account substantially.
So I think that's pretty good for the similarities. Like, if you guys have any questions about that, just drop it in the chat there. And we'll definitely get to it. Ralph's quickly asking, Jordan, where are your clocks at? You're sounding like a real sophisticated trader, but you don't even have clocks.
Yeah, no clocks. No clocks.
How do you know when the London session starts, man?
Yeah, is the market?
You don't have your London clock.
Now?
What?
Is the stock market even open right now? I have to.
Honestly, I don't know. I don't really trade. I don't really.
It's Saturday, right?
Yeah, exactly. Right. Honestly, Kyle, Jordan told me that you like. So Kyle just said, you guys are back to your roots. I love these types of lives. Honestly, Kyle, you're the inspiration. You were our muse for this live, right? We had a chat about. He said that this was like the lives you really liked, and I was like, you know what? I enjoyed these too. I'm sure other people would enjoy them. Let's keep it going.
Yeah, big shout out to Margin on this one.
Exactly. Thanks, Kyle. So what about the differences? Right? Differences between institutional investors and retail investors. What do you think?
Well, one thing is they got a huge pool of capital. They got much larger capital, much better infrastructure. They got a team, which is actually a huge resource. I'd honestly say that that's probably. Oh, they also have access to a lot cheaper capital.
Like margin, really, borrowing,
yeah,
things like that.
Exactly, right. I'd probably say those are the major ones that make the difference there, and okay. Also they have like different
products
and also risk tolerances, right?
Yeah. So I was actually going to say, like, when you share these things, right? Like the main differences between retail and institutional is that institutions have more money, better infrastructure, better, bigger teams, better margin, different risk tolerances. I'm sitting here saying this is a serious uphill battle as a retail trader. How am I ever supposed to beat these guys? So are these pros or cons, or are there pros and cons to each of these things?
Yeah, they're definitely pros and cons. Having more capital is definitely not a pro, right?
That sounds counterintuitive to what most people would think. Why would having more capital be a disadvantage as a trader?
Yeah, and I would say it's a disadvantage in terms of return on capital.
Okay.
So in terms of dollar amount, you're obviously going to make more money if you have more money. But in terms of return on capital, it is a disadvantage, right? It's easier to go and super quick example. If you have $0 and you go work a part-time job at your local grocery store, well, your return on capital is going to be humongous.
Yeah.
Right. Just like in trading, you can find these like really, really, really capacity constrained strategies that are only good for, let's say, 100 grand a year. Right. So
okay.
and you that have huge returns on capital. As a retail trader, someone that's trading, let's say, I think I saw, I can't remember where I saw it, but it was like the average retail investor has a $10,000 to $25,000 or $5,000 to $25,000 account
Yeah, I
size.
believe it. Yeah. We talked about that.
And so, the areas that you can go with that $25,000 is huge. But you can go into these tiny little crevices in the market and actually find these inefficiencies, right? That, let's say, a bigger guy can't go into. I'm hitting an inefficiency right now, and I had to talk with someone about it because I was a little confused on why it was there and why why it was working. And I trusted this one guy because he's way too big. He's way too big to even bother with it.
Oh, that's really smart.
Yeah. So and I'm also pretty close with him as well. So I feel confident reaching out to him with these really capacity constraint ideas. It's just not worth the time investment to, if you're only going to be looking, let's say, make mid six figures, right? When you're trying to make, 8 figures in a year.
Mm-hmm. And that, it's funny, like that sort of offsets a lot of the advantages that the big guy would have. It's like, it doesn't matter how good your infrastructure is. It doesn't matter how big your team is. It's still not worth it for you going after $1. But if you only have a penny, it's totally worth going after the dollar.
Mm-hmm. Yeah. So I think that's a big advantage to a retail. When we say retail, we're talking about the majority from $5,000 to $25,000.
We're talking about self-directed investing.
Yeah. One thing though that actually is tricky, and that's the Pdt rule, right? You can't trade too often. You can't get short volatility, right?
We don't have that in Canada, right?
We don't have it in Canada, but we have it in the States, and I think there's a couple other countries that do have it in Europe. So if you have a $10,000 account, I don't think you can go and just short a straddle.
No, you can go and short a straddle, but you can't open and close it in the same day more than like twice a week or something.
Got it. Yeah, most of the inefficiencies I've seen, they haven't been like intraday trading.
Yeah, it's usually something a little more fundamental, I guess.
Yeah. There's definitely a lot of inefficiencies that last quite a long time to play out, like maybe a week, 2 weeks.
Cool. Okay, last point here. If you guys have any questions, drop in the chat. If not, this will be the last point for tonight's live. One other difference between institution and retail that I wanted to touch on quick was risk tolerance. So the PA guys, you're going to be pretty familiar with this topic. We talk about it almost every day, I think. But Jordan, you'd mentioned that one of the big difference between risk and one of the major differences between institutions and retail is their tolerance for risk. Why is this a pro or a con when we're here up against these giant firms?
Yeah. So most of the time, these guys are the bigger firms are trying to maximize their Sharpe ratio. So your risk adjusted return, and that could definitely be an issue where it comes to you can't have these massive drawdowns, right? If you go through, let's say, a 20% drawdown, or even a 10% drawdown, your capital might get pulled. Or you have investors, they don't want to see a 10% drawdown. They'd rather see they're okay with making only a few percent a year, rather than making, let's say, a lot of money, but having these massive swings. So I think, as a retail investor, we are, we kind of have that luxury where there's no risk manager looking over our shoulder saying, "Hey, what the hell are you doing? Right? This is too much risk."
Why is that important?
Well, if we see an inefficiency, we got to hit it as hard as we can, right? And as an institutional investor, he might not be able to do that. He might only be able to allocate a certain amount of capital because that's what meets their risk budget.
Yeah, and there may even be strategies out there with positive expectancy that have just a lot of variance, right? Like earnings, right? The whole earnings thing that we do every day, guys. You've seen some of them. We make great money on. Other ones, they're blowouts, and we lose a ton of money. And that level of variance, while it makes money in the long run, could you don't. Let's say you have a bad quarter, you don't need to go explain it to someone. Whereas the PM has to go explain it to the risk manager and the investors, right? You can sit there and say, okay, yeah, sure, we lost some money this quarter, but we know that running this is a profitable way to trade. So, has anything fundamentally changed in the strat? No. Let's hit it again.
Hmm. Yeah, exactly right. Whereas if we go through a drawdown, let's say on a institutional level, the next quarter your capital might be half,
Yeah.
right? So
You're
now
gonna get
it's
your
gonna be
ass
harder to
kicked.
make that back, right? But as a as an individual, we can really say, okay, well, this is what happened. This is why we have that drawdown, and we're going to come back firing next quarter and hit it again.
Yeah, right. Like the thing you mentioned about your buddy who sold those the leaps on GameStop,
Hmm.
right? Because they were so expensive. Like a fund can't come in and do that
Right.
because there's way too much realized vol in the thing. That sure, it's like it's a really good trade, and your buddy made a
Hmm.
ton of money off of it, but you wouldn't be piling $200 million into it.
Yeah.
So unless you're like small medium sized account, you're probably and medium size could be like $20 million, even $10 million.
Hmm.
You can't basically if you have to answer to someone, it might be too much risk to take on. Yeah, I guess
Definitely.
that pretty much sums up the differences between the two. They're not that different from us, but those differences actually they're not always negatives, I guess is the big thing, right? Just because they have more
Yes.
money, it doesn't mean that we're at a disadvantage. Right? They might
Yeah.
make more money than us on a dollar amount, but on a percent return, we almost certainly should be outperforming them.
Yeah, and you can you have to use your strengths, like
To your
that you have
advantage.
for you to your advantage, right? Don't if you're a really good swimmer but you suck at running, don't go try and run against the Olympians.
Against
Stick
Usain
with
Bolt.
swimming. Yes, stick with swimming and really leverage your strength there.
Mm-hmm. All right, everyone. That is going to be it for today's live. If you guys like that, please just drop a like on the video. And I'm going to be posting this live up as a recording if you want to come back and listen to it. We're going to be doing these, sort of like podcast style lives every single week, right? Once a week, we'll do it for a half hour.
Let's do it.
And then, of course, I'm still going to be here in the mornings doing my trade breakdowns Monday to Thursday. And if there is anything worth talking about on the Friday that we see in the market, a trade idea, something like that, we'll share it as well at the start of the live. But make sure to come next week, Friday, with some questions prepared. This is it's a cool session, Jordan, and I appreciate you helping out with it. So, guys, if you liked it, drop a like on the video. Have a good weekend, everyone, and we will see you on Monday.
Yeah, happy Friday, guys.
Happy Friday.